Hey finance fam, welcome back to my channel. In today's video, we're going to do a little bit of storytelling and I'm going to lead you to a very important lesson on risk taking in your investment portfolio. Are you taking on too little risk or are you taking on too much risk? And all of this stems from a pro bono financial planning session that I did this past month with a single working mother, and she fortunately has set herself up in a very, very good way with pensions into retirement. And there was a very big lesson that came out of my session with her that I thought would be a great topic for a video, because a lot of people might be making this mistake by being too conservative in the portfolio. You're invested way too conservatively and you have way too much fear to where you are possibly not going to achieve the goals that you thought you were going to achieve by putting money in an IRA or a 401k. So there's a balancing act that we have to take on as investors. We have to think about what our risk tolerance is, and we also have to buy assets that align with that risk tolerance so that we stay the course. But the problem is so many people, as I do pro bono sessions, I learn this and I realize this, that there are so many people that simply don't get the education around investing or even around knowing their risk tolerance. They're kind of thrown to the wolves. They go to work, they're told by their, HR department, "Hey, tell us what your risk tolerance is and we'll construct a portfolio for you. Fill out this survey and we'll construct this portfolio for you." But there's a lot missed in that process, especially something like thinking about what's going to happen with those assets down the road. Some people actually won't need their assets right when they retire. They may actually never need their assets, especially if they have pensions that are going to cover their fixed expenses. And those assets may end up passing to their children or to their loved ones, and they may never need them. And you have to invest not only for the risk tolerance, but you also have to invest for the goal too. So it's like this balancing act that you're having to do when you're taking on risk in a portfolio and deciding what you're going to invest in. So this particular person was invested in simply short-term treasury bonds. That's it. Essentially, think of it like a money market fund. They weren't even bonds, they were bills, right? They were very, very short-term money market fund like investments, treasury investments. These are going to be low to no risk, right? They're considered the risk-free asset, really, is what they're considered. And they're not going to give you a high return over time. The lower the risk that you're taking on, the lower your return is going to be. And that's demonstrated here. So what I did was in YCharts, I charted a few different types of bonds. So I charted the LQD ETF. It's a bond ETF that invests in corporate bonds, which is the orange line. And I also charted the 20-year Treasury ETF TLT, and that is the purple line. And what you can see is you can see the returns going back all the way back to 2002. So these bonds, ETFs, these are the returns that we've seen since 2002, 144% and 154% for the 20-year Treasury bond ETF. So that sounds pretty good, right? But then you look at something like the S&P 500 ETF, which has been invested in large cap, the top 500 largest stocks, right? That's going to be your Apples, your Googles, your Facebooks. So the SPY, which is the ETF tracking the S&P 500 index, this is a much, much different return profile than bonds. And that's how it works, right? Bonds are lower risk, they're going to be lower return. Stocks are higher risk, they're going to be higher return. But you can really see the difference in return significantly on this chart. We're talking about a 568% return over or since 2002. And this is kind of fundamental, and you would think most people would be very clear on this, but there are a lot of people that are not educated on the significant difference in the return profile between stocks, bonds, commodities, and just all of the different types of assets. And then you get into bonds and dive into corporate bonds versus treasury bonds. And then you're looking at, something that's also quite different as well. And then you get into what this person was invested in, which was basically a money market mutual fund that's going to invest in very, very short term treasury bills. And now, you're looking at a return profile that is even lower because you're not taking on risk in something like that to be able to even get much of a return. Sure, lately we're starting to see interest payments become much higher as the Federal Reserve has raised interest rates. But, the point is, this person specifically didn't know enough about the differences in the return profiles and didn't have the confidence in what the goals were and what really was needed out of this portfolio to be able to make that decision. So, sitting with her, the kicker here in all of this, her being invested in a very low to no risk asset in her portfolio, the kicker with all of it is that she's probably not even ever going to touch the money in this account. And the reason for that is because she has a pension that's going to cover her fixed expenses in retirement plus some. She worked very hard and established a very, very secure retirement for herself. And so the problem with that, and it's not a problem, but the issue with having a portfolio that's invested extraordinarily conservative that you're not even probably going to need, and it's more likely going to pass down to your children, that means that the portfolio can be invested a little bit more aggressively, and it could be invested in more equities, more stocks, right? Maybe a little bit or higher risk bonds. You can really take on and move up the risk spectrum a little bit more when you have your fixed income covered by a pension and you are likely not even going to be tapping into the money. I mean, you might tap into the money, but it's going to be more unlikely that you would, and it's more likely you'll pass the money down to your children. So that was kind of the kicker with the whole thing is, she was very, very afraid to invest the money because of just lack of education around investments and how asset classes work. And so she had it so conservatively invested when the goal did not align with the risk that was being taken on in the portfolio. So that's something that I just wanted to kind of tell the story and address because, it's possible that you could be taking on too little risk in your portfolio. Not only think about your risk tolerance, but also think about the goal of the portfolio and what you can do and how you can invest that money to be able to manage not worrying so much about it, and you can take on a little bit more risk because the specific goal allows you to be able to do that. And again, just want to kind of point this out that the risk profile and return profile of different assets are, significant to pay attention to. And if you are too conservatively invested into too many bonds for your age or too many bonds for the amount of time that you're going to be investing or too many bonds for the goal of the portfolio that you may not even need, you need to consider that and possibly consider taking on a little bit more risk and putting in maybe a higher return, a higher risk asset. Even if it's not, it doesn't have to be a lot. It doesn't have to be a significant shift in the portfolio, but even, 10, 20% of a shift can make a big difference in terms of your allocation to different assets. So that's definitely something that you should consider. So step one is first, yes, look at your risk tolerance always, but that's not the only thing that you should be doing. The second thing that you should be doing is actually thinking about the goal of the portfolio, what that portfolio is going to be accomplishing, and when that portfolio is going to be accomplishing that goal. If you have more time ahead of you until you need that money, then you can take on a little bit more risk. If you think that that money is going to be inherited by your heirs, you can probably take on a little bit more risk. But a lot of this is just simply educating yourself and realizing that it's okay to take on risk as long as you are managing the allocation properly, for one, and two, you're managing the goal and the purpose of that money so that you're not strapping yourself or putting yourself in a bad situation. All right, finance fam, hope that's helpful. If you like this video and want to hear more stories, more tips, more tricks about how to manage your money and invest, please like this video. Subscribe to my channel if you're not subscribed. Why are you not subscribed? And I'll see you next time.